ARM did almost everything investors wanted. It beat revenue expectations. It beat earnings estimates. Its AI business continued to grow. And demand from hyperscalers remained strong. So why did the stock keep falling? Was Wall Street worried about slowing smartphone demand? Was the company's AI story no longer exciting enough? Or had expectations simply become impossible to satisfy? The answer isn't as obvious as it seems. Because this wasn't a quarter about weak fundamentals. It was a quarter that revealed the growing gap between a great business and a stock priced for perfection. So in this video, let's uncover the real reason why good news wasn't good enough, and whether the market may be missing the bigger picture. At first glance, ARM delivered another strong quarter. Revenue exceeded expectations, earnings came in above consensus, and both licensing and royalty revenue continued to grow. More importantly, management highlighted continued momentum in AI infrastructure and data center computing. None of those numbers suggest a business in trouble. Yet the stock remained under pressure. That tells us something important. The market wasn't questioning what ARM achieved last quarter. It was questioning what comes next. For a company trading at a premium valuation, meeting expectations is rarely enough. Investors needed evidence that ARM's AI opportunity was accelerating faster than they had already priced in. The real issue wasn't the quality of the quarter. It was whether the future looked even better than investors had imagined. To understand the market's reaction, we first need to understand how investors were valuing ARM before earnings. This wasn't a stock priced for average execution, it was priced for exceptional execution. Investors weren't simply expecting another solid quarter, they were expecting clear evidence that ARM's AI business was entering a new phase of monetization. That expectation was supported by ARM's unique position in the AI ecosystem, where technologies like Neoverse, compute subsystems, and data center CPUs are becoming increasingly important. But when expectations become exceptionally high, the standard for success changes. Beating consensus estimates is no longer enough. Investors want evidence that long-term earnings power is improving faster than previously assumed. Without that, even strong operational performance can fail to move the stock higher. Now let's separate perception from reality. ARM's underlying business remained healthy. Revenue growth was driven by strength in both licensing and royalties, showing that customers continue to invest in ARM's technology while existing deployments generate recurring income. Management also pointed to continued momentum in AI infrastructure, with data center demand remaining a key growth driver. This matters because royalty revenue reflects chips that are actually being shipped into the market, not just future design wins. In other words, ARM isn't simply signing new customers, it is already benefiting from increasing deployment across its ecosystem. The earnings report did not reveal a weakening business. It confirmed that ARM's business is still executing well. The real question, therefore, is why those strong fundamentals still failed to satisfy investors. This is where the market's expectations and ARM's results began to diverge. AI-related growth remained strong, particularly in data center infrastructure and the adoption of ARM's Neoverse platform. Those trends reinforced the long-term investment thesis. However, none of them fundamentally changed what investors already believed before the earnings release. The market had already priced in the assumption that AI demand would continue expanding. What investors were looking for was a new catalyst, evidence that ARM's monetization of AI was accelerating beyond those expectations. Instead, management largely confirmed that the business was progressing as planned. That's a positive outcome for the company, but it wasn't enough to justify an even higher valuation. For premium growth stocks like ARM, confirming the story often isn't enough. Investors want to see the story become even bigger. Earnings tell investors what a company has already accomplished. Guidance tells them what management expects next. And for high-growth companies like ARM, the market typically places more weight on the future than on the past. While ARM delivered another solid quarter, its outlook did not significantly change the long-term earnings trajectory that investors had already priced in. Management remained confident about AI, but it did not introduce a major upward revision that would force analysts to materially raise their earnings forecasts. As a result, investors had little reason to assign an even higher multiple to the stock. This is a critical distinction. The market wasn't disappointed by ARM's execution, it was disappointed that the future looked largely the same as it had before the earnings release. That difference explains why a company can beat expectations and still experience selling pressure. While much of the market focused on the headline numbers, one metric deserves closer attention: royalty revenue. Unlike licensing revenue, which can fluctuate depending on the timing of new agreements, royalty revenue is generated when ARM-based chips are actually shipped. In other words, it reflects real commercial adoption across the semiconductor industry. During the quarter, royalty revenue continued to grow, supported by higher-value chips and increasing deployment in AI infrastructure and data center applications. That suggests ARM is benefiting not only from new design wins, but also from broader production across its existing ecosystem. This is an important distinction. Licensing tells us what customers plan to build. Royalty revenue tells us what the market is already using. For long-term investors, that may be the more meaningful indicator of ARM's underlying business strength. One reason the market may be underestimating ARM is that it is still evaluating the business using today's revenue mix rather than tomorrow's. Historically, ARM generated most of its royalties from smartphones, a mature market with relatively modest growth. But AI is changing where value is created. As cloud providers build more AI infrastructure, demand is shifting toward higher performance CPUs, custom silicon, and advanced compute platforms. Areas where ARM's technology is becoming increasingly important. This transition will not happen in a single quarter, and management has never suggested it would. Instead, the investment thesis depends on a gradual increase in the share of royalties coming from higher-value AI and data center chips. If that shift continues over the next several years, ARM's earnings power could expand even if smartphone growth remains modest. That is the longer-term story investors should be watching. This brings us to the central investment question. ARM is undoubtedly an expensive stock by traditional valuation metrics. The market is assigning a premium because it expects years of AI-driven growth, not just another strong quarter. That premium creates a difficult challenge. Every earnings report must reinforce an already optimistic outlook. But investors should also recognize that ARM's business model is fundamentally different from most semiconductor companies. It doesn't need to win the AI chip race itself. Instead, it benefits when more companies adopt ARM-based architectures across smartphones, cloud computing, automotive, and AI infrastructure. The debate, therefore, is not whether ARM is a high-quality business. The real debate is whether today's valuation already reflects that long-term opportunity, or whether the market is still underestimating how large that opportunity could become. Rather than focusing solely on whether ARM beats earnings next quarter, investors should watch the indicators that reveal how its AI strategy is evolving. First, royalty growth, because it reflects real chip shipments rather than future commitments. Second, adoption of ARM's Neoverse platform, which is increasingly powering cloud and AI infrastructure. Third, the expansion of compute subsystems, or CSS, which allows ARM to capture more value per customer than traditional IP licensing. And finally, management's commentary on hyperscaler demand and custom silicon, where companies like Amazon, Google, and Microsoft continue investing aggressively. If these indicators continue strengthening, it would suggest that ARM's long-term monetization opportunity is expanding, even if quarterly revenue growth occasionally fluctuates. For long-term investors, those structural trends are far more important than a single earnings beat or miss. Of course, every investment thesis has risks, and ARM is no exception. The biggest risk is not that AI demand disappears, but that ARM struggles to monetize that demand as quickly as investors expect. If royalty growth from AI infrastructure takes longer to offset the slowdown in smartphones, earnings growth could fall short of the market's ambitious assumptions. Another risk is increasing competition from alternative architectures, particularly RISC-V, although its commercial ecosystem remains significantly smaller than ARM's today. Finally, ARM's premium valuation leaves very little room for execution mistakes. When expectations are this high, even a solid quarter can trigger a sell-off if investors don't see accelerating momentum. That's why the market is watching not only whether ARM continues to grow, but whether its AI business grows fast enough to justify its premium multiple. After examining the evidence, one conclusion becomes clear. ARM did not disappoint because its business weakened. In fact, the company's core fundamentals remain solid, with continued growth in royalties, expanding adoption across AI infrastructure, and a business model that benefits from the long-term shift toward custom silicon. The real challenge is that investors are no longer asking whether ARM is a great company. They are asking whether its future will be even greater than what today's valuation already assumes. That is a much higher standard to meet. So the recent sell-off may say less about ARM's execution and more about the extraordinary expectations surrounding AI leaders. For long-term investors, the key question is no longer whether ARM has an attractive business model, but whether the market has become too impatient to recognize its full potential. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.